In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, press play. Spotify makes not one but two big podcast acquisitions, opening a new front in competition with Apple. Plus, game over. Shares of big game makers Take-Two and Electronic Arts plunge. Is the Fortnite phenomenon to blame? And promises. In a high-profile photo op, President Trump and Foxconn vowed to transform Wisconsin into a high-tech manufacturing hub. But workers tell us it's not happening. First to our top story, fresh off announcing that it made its first ever quarterly profit, Spotify also revealed a big bet on podcasting. The streaming service is buying podcast companies Gimlet Media and Anchor FM. Price tag, a reported $200 million. In a blog post, Spotify CEO Daniel Ek explained his strategy, saying, quote, "In just shy of 2 years, we've become the second biggest podcasting platform. Based on radio industry data, we believe it's a safe assumption that, over time, more than 20% of all Spotify listening will be non-music content." Mitchell Green, partner at LeadEdge Capital, is with us. LeadEdge is an investment fund with over $1.8 billion under management and counts Spotify, Uber, and Alibaba in its portfolio. He joins us now from Santa Barbara. And with us from LA, Bloomberg Tech's own Mark Gurman. So obviously, Mark, this opens a new front in competition with Apple. What do you make of this acquisition? Mark isn't with us. So Mitchell, we will start with you. Since you were an early investor in Spotify, what do you make of this change in strategy?
I don't really think it's a change in strategy. They've actually been telling investors for a while that it's an area of interest. I think it's driven by, look, they want to control, they want to be in a position to, take advantage of any time consumers are listening to things, and podcasts are becoming listened to more and more. That's from like a consumer cultural perspective. I think there's a strong financial desire as well, though. Podcasting will have much higher gross margins for Spotify due to that you don't have to pay the three big labels, and I think there are some very financial reasons for getting into podcasting as well.
So, Mark, podcasting is still sort of a niche business, and Apple hasn't really paid much attention to it. What does this mean for Apple?
For Apple, this might indicate that Apple Music, the core of the functionality, is not the only thing that they're up against in terms of competing with Spotify, who's obviously number one in the streaming category, and podcasting is there too. Over the past couple of years, they've really tried to position themselves as being at the top of the podcast market, which I believe they are. They renamed their podcasts app just to Apple Podcasts from iTunes Podcasts. They've been pushing it heavily on social media. They've been asking content creators to push it more heavily. So this could just give them another opportunity and another reason to continue to invest in the podcasting app.
Mitchell, how big of an opportunity do you think this is for Spotify in particular? I mean, when you look at the economics of podcasting, yes, a lot of people are listening, but it's not a huge slice of the advertising market.
I agree. It's still early. Although I do think it's still early, no question about it. Nobody has made a lot of money in the U.S. at least. In China, people have been way more successful monetizing podcasts across Alibaba and other platforms, and then Tencent and other platforms. But I think it's a big opportunity for them. They've got the users. I'm sure they're going to start to push the podcast into people. I think this is all about gross margins. The stock was down a little bit today, frankly, because they gave a little weaker gross margin guidance for a decline in gross margins than people would have thought. It came back a bit in the end of the day, but I think this is a lot about how do you get less reliance on the three major labels, and all the negotiations are coming up this year as well.
Mark, do you think that Spotify taking a big step into this market could lead Apple to make some moves as well?
Yeah, absolutely. I think that Apple Music has become increasingly important to them. Services have become increasingly important to them. It'll be interesting to see how Apple begins trying to monetize podcasting, if they want to play that into their growing services segment. Maybe a subscription-related thing to podcasts, maybe original content in the podcasting world that ties in between the podcast app and Apple Music. I think there's a lot of opportunity there for Apple in the podcasting space for sure.
That said, Mitchell, Spotify shares got punished today on concerns about revenue per user shrinking. What do you have to say about that?
I think the stock was down on gross margin guidance. I think most institutional investors care about gross margins here, and the long-term bet is, management said they can have 35% gross margins. I think they had like 25.7 this year, and now they're guiding to 23, 24 next year. I think they say it's due to podcast investments. I think there's a lot of investors who believe that they will continue to get a better deal this time around with negotiations with the labels. Management came out today and said, look, that's not the case. We think it's going to be it's going to be pretty much the same deals. They also did note that part of the reason gross margins are declining, though, is they're entering new markets, and oftentimes you have like big upfront guarantees that have a negative gross margin. Like India is the big market they're going into, so that's some impact as well. Look, the stock was down like 6 or 7% pre-market, and it ended down 2%. So there's clearly buyers in there buying the stock, taking advantage of weakness.
Mark, give us an update on the competition between Spotify and Apple in music. I mean, Spotify is still in the lead when it comes to paid users, but Apple Music is number 2.
Yeah, Spotify is definitely in the lead, but Apple has had some very strong momentum with Apple Music lately. And the one thing that cannot be forgotten is this user base of iPhones. Apple said there's 900 million iPhones in use. They said this on their earnings call at the end of January. And the thing about that is that Apple Music is built into all those devices if you're on some of the more recent software updates. Apple Music, it came out starting in iOS 8.4, which was, I believe, 2015. And there's some phones probably still running that operating system, but it's supported by probably a good chunk of those 900 million phones. So they have a very easy way, per se, to tap into those users, an advantage that a Spotify does not have because they're not a hardware maker like Apple is. But obviously Spotify's expertise, it's basically the only thing they do is this streaming music service. So they have a leg up from that department because they could be all in on it, whereas Apple Music is just one part of the bigger picture for Apple.
Now, Mitchell, you're also an investor in Uber. Obviously, it appears like it's going to be a big year for tech IPOs, barring another government shutdown. What's your outlook for 2019?
As long as Trump doesn't shut the government down again. So if Trump doesn't shut the government down and the SEC doesn't shut down, although we have heard even if the government does shut down, supposedly the SEC is working on ways to continue to get filings. I think you're setting up for a strong IPO year. There are, it's been rumored that there are a bunch of big software companies like a Zoom or like a Slack, or internet companies like Lyft and Uber. You might see Didi. There's a bunch of great companies out there, and there's clearly demand from institutional investors for growth. You can see it across software names in the public markets. They trade at really high multiples. And again, the stock price is a function of supply-demand. People want to own growth in the market. And so I think I think it'll be a good year for IPOs. But I always do get worried.
Uber's still losing a lot of money. Do you think that will turn some investors off?
I think when the big institutional investors spend time with Dara, who obviously came from Expedia, they will be pleasantly surprised at the unit economics for the business. They have a business, Uber Eats, which is $8 billion, and Q3 was on an $8 billion plus run rate. Growing like 150% a year. And so, they're spending a lot of money on that, which I think investors will fully appreciate. Two, they're still spending a lot of money on autonomous. a huge amount of money. I don't really have an opinion if they're doing the right thing or the wrong thing. And look, there's also precedent for companies growing really fast. I mean, Netflix along the years has burned huge amounts of money building content. Tesla burns huge amounts of money. Amazon for many, many years built huge amounts of money. I think there's going to be strong demand for Uber, just given the global. If you want to own a global internet company that could touch 1 billion plus users, like there aren't many of them in the world that are growing, 30+% a year. There aren't many to own. This is one of these assets.
All right, Mitchell Green, Lead Edge Capital. Always great to have you with us. Bloomberg's Mark Gurman.
Thanks again.
Thank you both. Well, shares of the New York Times hit a 13-year high Wednesday as online subscriptions rose in the fourth quarter of 2018. The publisher added 265,000 new digital subscribers last quarter. It ended the year with over 3 million digital customers. The Times says it wants to have 10 million paying customers by 2025. Coming up, shares of Take-Two and Electronic Arts both dropped after the video game makers reported disappointing results. Could they be feeling the pain of the Fortnite effect? And if you like Bloomberg News, check us out on the radio. Listen to the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Stripe, the most valuable payment startup, closed a new funding round last week from Tiger Global Management, totaling $100 million. Stripe said the deal pushes the company's valuation to $22.5 billion. Speaking to Bloomberg, CEO Patrick Collison warned he sees the biggest economic headwinds for global companies coming in 20 years, meaning international expansion will be more difficult. Well, the competition in fintech is getting fierce in 2019. Nomura came out with a note saying Square's downloads have outpaced PayPal's Venmo app. As a result, Square's stock hit an all-time high. Bloomberg's David Weston recently sat down with PayPal CEO Dan Schulman and talked about the popularity of Venmo.
I think Venmo is really one of the crown jewels of PayPal. It today is already at a $70 billion run rate in terms of processing that goes over that Venmo platform. It grew last quarter at 78% year-over-year growth. And for 3 quarters in a row, the number of net new actives coming onto Venmo has hit a record each and every time. And so we're really pleased with Venmo. But what Venmo really is it's a value proposition oriented to the millennial generation. And the reason that it's so successful there is that it basically takes every payment and turns it into an experience. When you do a payment, you tag that payment with either an emoji or what it was for. You share it with your friends. You can split transactions with your friends. And it really ties into this whole social network experience that the millennial generation grew up in. So its magic is that it's not so much a payment application as it is sort of an experience application. And its virality, we spend almost no marketing on it, and it just grows by leaps and bounds right now.
Every millennial I know actually talks about Venmo and uses it. No, there's no question about it.
Yeah, and they check it 4 to 5 times a week to see what friends are doing. It's a fascinating look at kind of where digital payments and every segment of the market has a different way of thinking about what are payments like. You and I probably think differently. You probably are more private about your payments. You probably have less than 600 friends, But as you grow up, the millennial generation grew up with screens in front of them. They grew up with social networks. Their public-private lines are much more blurred than other generations are, but they're incredibly responsible around money. They grew up in the Great Recession. They saw parents or friends get scarred by that, and so their desire to control their finances, create the right budgets around it is really quite admirable.
Venmo was a huge success in terms of, as you say, its virality.
Yep.
Is it as successful financially? How do you make money off of it? What's
Yeah.
the potential there?
So the best way to think about Venmo is to think about PayPal. PayPal started off as a free P2P service, peer-to-peer service. Venmo started off as a free peer-to-peer service. Now what we're doing is we're adding more and more capabilities to Venmo that are what we call monetizable. So a Venmo user can shop and buy from Uber, from any PayPal merchant here in the US, and they take that out of their account, and the merchant pays us a transaction fee for that. We've put a Venmo card, a debit card, so somebody can use their Venmo balance and account at offline merchants right now. We earn money off of that. If you want to take money immediately out of your Venmo account to your bank account, we charge a small fee for that. So we're basically very slowly but very surely building capabilities and benefits to the Venmo user base that add more value to them, but also start to create a financial model for us. And basically last quarter, we really saw a tipping point on that, where the amount of people who are doing a monetizable transaction on Venmo is just exploding right now.
At what point will you make as much or more money off of Venmo as you do off of PayPal?
Yeah, good question. We probably don't really talk much about that, but Venmo is a accelerating, growing part of our business, and the monetizable part of that is accelerating as well. So it's an exciting part of our model.
PayPal CEO there, Dan Schulman. You can watch the full conversation tonight on Big Decisions right here on Bloomberg Television. Coming up, Epic Games Fortnite is killing the competition as rivals like EA and Take-Two, along with Activision, lower their forecasts. We will discuss next. And Bloomberg Tech is live streaming on Twitter. You can check us out at Technology and follow our global breaking news network TikTok on Twitter. This is Bloomberg. Add Take-Two Interactive to the list of video game makers being crushed by Fortnite. The producer of Grand Theft Auto came out with a revenue forecast that was well short of estimates. The same thing happened with Electronic Arts a day earlier. Shares of both companies plunged. Traditional game publishers under siege by the phenomenal success of the Epic Games shooter Fortnite. Joining us now, Bloomberg's LA Bureau Chief Chris Palmieri. So, is this all because of Fortnite, Chris?
Yes and no. I mean, Fortnite is a game changer, phenomenally successful, really a cultural phenomenon around the world, and sucking up a lot of people's time, and even more amazing because it's free to play. And so, you know, it gets into that, how do you compete with free problem for these traditional game publishers. But there's more than that going on. I mean, there has been sort of a revaluation of the industry as these companies were able to sort of extend the life of, like, for example, Grand Theft Auto Online and keep selling, you know, more versions of the game and in-game purchases and that. And so the industry was sort of reevaluated as being a lot more valuable because it had this sort of recurring revenue stream. Now it turns out, well, it's probably a lot more of a hit-driven business, just like it used to be, and you can't always count on those customers coming on.
So what are Activision, Take-Two, Electronic Arts planning to do to take on Fortnite?
Well, you're seeing some copies of games that are sort of taking on some of the most compelling elements of Fortnite. For example, this Battle Royale mode, which means players, 100 players compete against each other. It creates a very exciting and addicting sort of form of play. So some of these games are coming out in that mode. You're seeing some games that are starting to come out, very visually appealing games, but they're free to play as well, and sort of going to make up their money through purchases of decorative items in the game, like Fortnite does. And they're going to refocus their efforts on just creating really killer games that stand out, like, for example, Red Dead Redemption 2, which was the best-selling video game last year from Take-Two.
What do the traditional game publishers have going for them?
They do have these existing franchises. If you think about a Madden or a Call of Duty, that they may not have been the hottest games last year, but they do have lots of fans and people that come back every year to see the latest versions of those. They of course have the money and and networks to distribute these games, both the traditional in stores and online as well. And so they're far from done. They've just got to learn to compete in this new world.
So what do you see? What's your outlook for the year, for 2019?
Analysts are pretty predicting, a flattish year. Big players like Activision does not have the strongest lineup it's had in the past, and so it may be a very difficult one as sort of these investments in these new modes of gameplay and these new sort of marquee franchises come around.
So, what are the trends that you are going to be following? Obviously we've been talking a lot about gaming addiction. The landscape is changing dramatically when it comes to attention share, whether it's on games or social media. What are the hot button topics going to be this year?
One thing we'll be watching, as I mentioned, Take-Two had this game, Western-themed shooting game, Red Dead Redemption. It was the top-selling video game in 2018, and they've just now started an online version of that. And so, as they had some bugs in that. People said the items they were buying in the game were too expensive. They're tweaking it, and so as you go forward, you're going to see, well, to what extent can they extend the life of these games, even a hit game, through continued online purchases? That's going to be a big thing, because that's sort of what the future of the industry is bet on, that people are going to go directly to game makers and buy things online.
All right, Bloomberg's Chris Palmieri all over the gaming industry for us. Thanks so much from LA. Meantime, for the second time this year, Tesla is cutting the price of its Model 3 sedan. All versions of the electric car will now cost $1,100 less, bringing the base price to just under $43,000. Tesla says the cost cut will offset the end of a customer referral program that was a more costly incentive than the company realized. Coming up, we look into the tech IPO pipeline and what Chinese companies may come to the U.S. and hit the public market. That is next. And later, President Trump boasted Foxconn's expansion into Wisconsin last summer, but on the ground, things are not turning out as planned. We will tell you why. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Emily Chang in San Francisco, with Sherry Ott in New York and Heidi Stroud-Watts in Sydney. Let's take a look at the global tech stories of the day. Heidi, what do you got?
Emily, streaming music service Spotify is moving into podcasting. The company has agreed to buy Gimlet Media and Anchor. Terms weren't disclosed, but Recode earlier reported that Spotify is planning to spend more than $200 million on Gimlet. Gimlet has created podcasts such as Homecoming, which was recently adapted into a TV show for Amazon. Well, meanwhile, a tweet from Tesla CEO Elon Musk led to talks with Daimler over a possible collaboration on an electric van. In his November tweet, Musk praised the Mercedes-Benz Sprinter van. Daimler did well the last time it cooperated with Tesla. It sold a stake in the company in 2014 for a $780 million profit. And the founder of Japan SoftBank Group wants to close the gap between the company's market value and what he thinks it's worth. Masayoshi Son has approved the largest buyback in SoftBank's history, up to $5.5 billion of stock. Proceeds from the sale of the company's telecom business in December will be used for the repurchase. And those are the top global tech stories of the day. Sherry.
Heidi, thank you. Now, from trade tensions to Huawei, concerns about China continue to spiral in the U.S., but there's a brighter view when you look at the pipeline for Chinese companies that want to go public in the U.S. One of the optimists is Drew Bernstein, co-managing partner of Mark & Bernstein & Pinchuk, a consulting firm that guides Chinese companies through the U.S. IPO process. Drew joins us now here in New York. Drew, so you speak to Asian businesses all the time. What are Chinese firms specifically telling you about how they feel entering the U.S. market in this environment of trade tensions?
Well, I think the trade tensions right now are just sort of an impediment to the ultimate solution. And I just came back from China about a week ago. I met with perhaps about 20 CEOs and CFOs, and they remain very optimistic right now. Right now, there's 180 private companies with valuations greater than $1 billion that are considered unicorn companies. And the inconsistency there is a unicorn company is supposed to be a company that is special. And there's 180 of them. There's only 300 in the world right now, and 180 of them are in China. So I think that's what's kind of dictating the excitement right now.
How much of that has been helped by the Made in China 2025 policy trying to really boost these Chinese firms to have higher tech ambitions and lead in these spheres? How is that impacting the whole IPO pipeline process?
Well, I think it's really positive because China's been very clear with their Made in 2025 plan which sectors they want to become world leaders in. And for instance, our firm right now is working on about 10 IPOs. About 6 of them are in the fintech area. So I think we're relatively optimistic. And the Chinese companies, in looking at the United States, they both have something the other really desires that doesn't exist many other places. The Chinese companies look at the US market and they see the IPO market as a disclosure-based system, which means that you actually compete for who gets the capital. You have, for instance, the ability to do add-on rounds here. So you can have a second and third round of raising equity and raising debt. And probably more interesting is you have the ability for the companies to have this international platform, which gives them brand recognition and also gives them the ability to earn foreign currency to do M&A work, given that the renminbi is a restricted currency.
Drew, you've just got back from a tour through Asia. What would you say is the sentiment among Chinese business leaders, and how does it compare to U.S. business leaders right now in the middle of a trade war?
Well, I mean, there's nothing really good about a trade war, but I don't think that the trade war is going to actually change the direction. It's more of an obstacle. And there's still, I think, a lot of good sentiment to being able to go public right now. And the Chinese companies also have some choices. Hong Kong came off one of its best years ever. And a lot of the rules right now are changing even for the domestic markets. As recently as Friday, they permitted shorting now on the A shares. So I think that the Hong Kong market and the domestic markets in China are making progress and becoming more mature and are going to become competitors to the U.S. market. So Chinese companies have a choice.
Trade talks are going to continue next week, Drew, but still no plans for the presidents to meet again. How optimistic are you about these talks?
I think for us, any of us practicing in emerging markets, we have to have this kind of eternal optimism, but it's always tempered with concerns. And the real concerns I have, going forward, it's great that you have these 180 companies, and it's great to see that they're going to go public one day. But I think there's still a lot of money on the U.S. sidelines right now, waiting to see if these Chinese companies can really do certain things. And I think the challenges for the Chinese companies are going to be, one, to produce reliable financial statements. Two, to field good management teams that have experience and mature management teams. To be able to cope with things like related party transactions and to navigate governmental and regulatory regulations. It's going to be challenging.
Hong Kong has managed to attract big companies ever since Alibaba hit it really hard by coming and listing here in the U.S. Are they going to be strong competitors for these Chinese companies, Hong Kong, perhaps even the U.K.?
Well, the markets, they're going to become better competitors, I believe. Again, they don't necessarily offer the same kind of things that the U.S. market offers. One of the things that the U.S. market offers is very, very deep, diversified sources of capital, too, which is what these Chinese companies need. You saw last year maybe about 30 companies go public. They raised a little over $9 billion in the United States. So they'll have their choices. It'll be interesting to see, but you know, one of the things I've seen in China is I'm coming up on almost 20 years there now. And over 20 years, a lot of people have come and gone. A lot of the people that have gone are coming back right now, which means they're leveraging off of their relationships to try to get into these companies. So I think it's going to be a pretty interesting year for everybody.
So you say they'll have their choices. What choice do you expect them to make?
Depends on the company. I mean, if you're a Chinese company and you don't want to or don't think you can deal with the transparency issues, the regulation issues, then you probably shouldn't go public in the U.S. So it really depends on, you know, what your strategy is. If you're a Chinese company and you have no international ambitions, you can't cope with transparency or don't want to, or the regulatory issues, then you're probably better off staying on the domestic markets.
All right, choices. Drew Bernstein, Markham Bernstein and Pinchuk, co-managing partner. Thanks so much.
Thank you very much
for sharing your views with us. All right, markets across Asia remain closed for the Lunar New Year. Between an economic downturn and, as we've been discussing, a prolonged trade battle, the Year of the Pig's outlook is anything but certain. Heidi, you have a chart that delves into what the pig looks like.
Well, you know, the Year of the Pig is meant to be kind of fortuitous, you know, happy-go-lucky and should be quite good for equity investors. But as we can see from this chart, we've hardly seen a stellar start to the year. Part of this you can kind of blame on the fact that the start of year when it comes to any data coming out of China is always a bit of a tricky one, given that it is that seasonal uncertainty and volatility associated with the Lunar New Year, factories closing down, people going away on holidays and traders really kind of having signed off for the Lunar Year. But we did see the biggest China ETFs seeing record outflows in January so far. So, Emily, if this is anything to go by, we know that this has been a lackluster market. You know, you spoke about whether there's much in terms of a revival of animal spirits when it comes to deal making and IPOs in China. And there is, to pretty much everyone we speak to, that sense of, you know, undercurrent of uncertainty as to what's going to happen with this trade war, but also what's going to happen with this structural domestic slowdown and what that means for, you know, consumer trends, for the tech sector and for stock market investing. So, as you said, a lot of you know, investor anxiety and uncertainty going into this Year of the Pig. But in the meantime, you know, they're still off for today at least, and I'm sure traders are just spending time with families and eating dumplings, right?
Yum! I'm hungry.
Well, lots more ahead. Do stick with us. Lots more ahead here on Bloomberg Television. This is Bloomberg.
Facebook's top PR exec Karen Maroney is leaving the social media giant after 8 years. Her departure comes as the company remains under fire over privacy issues and its role in Russian efforts to manipulate the 2016 U.S. presidential election. Maroney will stay at the company until a replacement is found. Foxconn says it still plans to build a manufacturing plant in the state of Wisconsin, creating as many as 13,000 well-paying jobs for, quote, amazing Wisconsin workers as early as 2022. But many on the ground say this is simply not the case. Bloomberg's Austin Carr wrote all about it in this week's issue of Bloomberg Business Week and joins us now from New York. So, Austin, how do the promises here from Foxconn and the president differ from reality?
Yeah, so for the past couple months, we've been talking to a lot of people on the ground at Foxconn, some of their early operations there. And so far, the big differences are that they say things aren't living up to promises. The pay has been low. Workers feel expendable. Foxconn has been making an aggressive push towards more automation, meaning a lot of their roles would likely be sort of not around, obsolete in the coming years. People say training is an issue in that, indeed, in one case, a worker actually had his finger nearly sliced off on the production line. So there's just been sort of a jarring disparity between what was promised by the president and some of these jobs that are actually being doled out to residents of Wisconsin right now.
There are some issues that have developed just in the last few weeks whereby one of Terry Goh, the chair of Foxconn, one of his assistants, actually said the company was reconsidering some of its plans. Which plans exactly?
That has been a constant refrain throughout the past year or so, or ever since this deal was signed. It's actually gone through a ton of changes. First, they were going to build a massive factory. Then they scaled down those operations. As you noted just a couple days ago, they actually said, oh, we're not going to build a factory. And then they flip-flopped again after President Trump had a phone call with Chairman Go. So I think the bigger issue is that a lot of people don't know what they're actually building in Wisconsin. They've made a lot of commitments to their contract, but they're not actually sticking to those. Those plans have been evolving since it was signed. And a lot of the sources that we talked to for this story just say that the plans internally at the company, both at its downtown Milwaukee headquarters as well as its Mount Pleasant, Wisconsin factory, felt amorphous and ever-changing.
Wisconsin Senator Ron Johnson was on Bloomberg television earlier today and was asked about this situation. Take a listen to what he had to say.
The environment keeps changing. There's all kinds of uncertainty. Well, what businesses always want is certain and stable a business environment as possible. And so markets change. Apple reported less demand for their products. That obviously affects the equation. But in general, all the incentives that were given by Governor Walker were prospective.
Is this because of Apple?
It is partly because of Apple that there's been pressure on the company around the global market conditions, some of the trade war issues. But let's just remind the senator that they missed their first-year hiring targets, the maximum first-year hiring targets, by about 82%. They ended the year with only 178 full-time workers. That's far short of 1,040 that they committed to hiring at the maximum end of that threshold. The company can certainly afford to hire more workers. That's not just because of softened iPhone sales. But then the larger issue is what the senator is implying is that there's no risk for the state because they won't actually give any subsidies unless the company lives up to its hiring and its investment spend. And that's partly true. The truth is that they've already invested a lot of money, both in man hours, local and state commitments to infrastructure costs. Hundreds of millions of dollars have already been spent. And so there's sort of myth that there hasn't been any risk or any cost to taxpayers already. And that's just simply not true.
So, bigger picture, what does this mean for global manufacturing and the supply chain?
I think that the larger issue is that this romanticized notion that President Trump has sort of talked about and made a key campaign pledge, and indeed talked about in the State of the Union last night, it's really more challenging to bring that back to the U.S. than a lot of people had anticipated, at least the proponents. Of course, that would be fantastic if factory workers could come back. You could create more blue-collar jobs. But the truth is, it's really challenging, not just economically when you're competing against China and Mexico, but the larger issue here is that it's really hard to replicate that supply chain stateside. A lot of that network is set up in Asia, in mainland China, where Foxconn has most of its manufacturing operations. That's why when you have that network, it's easier to build things like iPhones. So trying to replicate that here in Wisconsin is going to be a huge challenge, particularly because there's not just the lack of supply chain, but also a lack of talent pool.
Has the president commented on this situation in particular recently?
The White House had declined to participate in our story, but an administration official did tell me that the president and the White House would be, quote, disappointed if Foxconn reduces its investments in Wisconsin. Any reductions they'd be disappointed with.
All right, Bloomberg's Austin Carr for us. That piece in this week's edition of Bloomberg Business Week. Thanks, Austin.
Thank you.
Still ahead, car makers are shifting gears and spending more money on electric. But is the infrastructure in place to meet growing demand? We'll discuss next. This is Bloomberg. NASA is gearing up for the launch of commercial rockets that will take Americans into space. Elon Musk's SpaceX will have a test flight March 2nd with a NASA crew set to go into space in July. For Boeing, a test flight is set for no earlier than April, with the manned mission no earlier than August. Well, by 2030, electric car sales are expected to surge to 30 million vehicles worldwide. This, according to Bloomberg New Energy Finance. One company preparing for the onslaught is EVgo. The company provides more than 1,000 public charging stations for electric cars, across 34 states. In the first half of 2018 alone, the company's network charged more than 42 million miles. I sat down with EVgo CEO Kathy Zoy to discuss the future of electrification.
I feel like we're at an inflection point. The car companies have announced $300 billion that they're investing in making EVs. There's going to be 160 new models over the next few years. This is going from crazy boutique small to mainstream, and consumers are going to love it. Everybody I know that's driven an EV loves driving it. So I think what the car companies and us in the industry have in mind is the cost has to be competitive, the range has to be strong, and there has to be charging infrastructure everywhere.
So Tesla is obviously in the lead here. Where are you seeing real competition from competitors, Audi, Mercedes? What company should Tesla be worried about this year?
Look, when they made their third quarter targets, every car company in the world, I think every boardroom said, oh my goodness. So I think they need to be worried about everybody. Now, what we see here in the United States is so much progress. I mean, General Motors is great. The Nissan has been around for a long time, but GM and Nissan now have over 200-mile cars that are affordable. That is obviously really big. I mean, Ford had historically been a bit of a laggard, and now Ford is leaning forward on making an electric F-150. So I don't think that there's a car company that's serious in the world that's not investing seriously in electrification.
Now, how far out are we really from mainstream adoption of electric cars and fully relying on charging stations?
We're a few years. I mean, we've already got 1 million EVs on the road in the United States. We suspect that that's going to be probably 6 or 7 million in the next 5 years or so, which is a lot. Which means, you know, and look, Bloomberg New Energy Finance says that it's going to be fully 10% of sales in 2025, but then an inflection point on the S curve, and we're going to be looking at 30 or 40% of sales in 2030.
So what's more needed in terms of infrastructure?
Well, what EVgo does is fast charging, and what we're seeing is, again, historically, most people who bought an EV charged at home. But what we're now seeing is people who live in apartments, they need to charge away from home quickly. The most interesting new bit is with the rise of the ride-hailing economy, where like my kids who are millennials don't want cars, but they do ride sharing all the time. Those drivers of those cars, like for Lyft and Uber, they need to charge quickly, and they need to charge away from home, and they charge a lot.
When are electric trucks going to hit the scene? And then how does the charging infrastructure change to support that?
The electric trucks are starting to hit the scene now. I would say that light-duty vehicles, regular cars, are a couple of years ahead of the trucks. But I just came from your Bloomberg conference, and there were a number of truck companies that had talked about. They said, "We've placed an order for 1,000. We've placed an order for a few hundred." So the experiments are beginning. But again, I say within a few years, you're going to see all fleets are going to be relying increasingly on electrification.
So how would you compare the road ahead in the U.S. market to China? What's the next 5 years look like in both countries?
Fascinatingly, the Chinese are moving really, really quickly. And the difference in the policy settings are what might make China move even faster. There's some say that right now it's even money. That we could win or China could win. But if the Chinese government puts policies in place to accelerate the market, then there are some people who would expect that 70% of EV sales in China, a very big economy, are going to be EV by 2030. And nobody thinks that the U.S. market will move quite that fast. So again, it has to do with creating policy reasons for the manufacturing to go ahead fast.
So what are the risks? Tesla broke ground in Shanghai on a factory. What are the risks you see to Tesla, which is in the lead, and the EV market in particular, over the next few years? Where are the biggest challenges?
I think that the market is growing so quickly. The market for non-luxury vehicles, there's going to be a lot of market entrants. So I think that Tesla's going to have to compete with that. They're going to have to compete on cost. They've got beautiful, beautiful vehicles. But look, the vehicles that Hyundai and Kia and Nissan and GM are bringing to market, they're going to compete with Tesla. It's going to be great. And EVgo is going to charge those cars.
Good for you.
Yeah, exactly.
My interview there with EVgo CEO Kathy Zoy. And that does it for this edition of Bloomberg Technology. Tune in tomorrow to Bloomberg Television. Twitter reports fourth quarter results, and I will be sitting down with CFO Ned Siegel, 2:15 Eastern, 11:15 a.m. on the West Coast. And we are live streaming on Twitter. Of course, you can check us out at Technology and follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.